I'm Gary Thomson, and let's take a look at what's driving the markets right now. And the big headline, of course, in the US is the government shutdown, which began on the 1st of October. Now, that sounds dramatic, but we've seen this before. Even the record 35-day shutdown back in 2018 to 2019 had very little lasting effect on the economy or the markets. Now, here's why. During a shutdown, hundreds of thousands of government employees are furloughed, but once things reopen, they're paid back. Now, the usual rule of thumb is that every week of a shutdown knocks around 0.2 percentage points off GDP. That drop tends to reverse quickly after the government starts running again. Now, however, in the near term, it is possible that market participants may become concerned, as the US economy isn't as strong as it was during past shutdowns. The job market is softening, and the Trump administration's threats of more layoffs could add extra pressure. So the shutdown is coming at a pretty bad time. It just adds more uncertainty to an already shaky outlook. There's another issue too. The Labour Department has warned that a longer shutdown could delay key economic data, like the jobs report, as we've already seen. That's a problem because the Fed is expected to cut rates by 25 basis points at the end of October. And if the data isn't available, policymakers may well hesitate. The longer the shutdown lasts, the more volatility we could see in the US dollar and across other forex markets. Now, might this affect the US stock market? Well, Wall Street seems completely unfazed. Indices are still near record highs, and most investors view shutdowns as short-term noise rather than a serious threat. The market looks strong to go through the shutdown. However, and yet again, nothing can be 100% certain. Now, whilst Washington is stuck in a gridlock, gold just keeps on climbing. Prices have hit all-time highs. We've broken through $4,000 an ounce. France's political crisis, which we'll talk about later, rising Japanese bond yields, and the US government shutdown are all pushing investors towards so-called safe havens. And with traders now pricing in a 25 basis point Fed cut rate this month and another one in December, gold is thriving in a low-rate environment. Non-yielding assets like gold tend to shine when real yields drop and uncertainty rises, and of course we've seen plenty of that. Right now, both fundamentals and momentum support the rally that's happening, and gold is above that $4,000 mark, and that's an important psychological level. Will it act as resistance, or will buyers push through to new highs, $4,200 per ounce, for example? That's what the market is going to be watching for next. Okay, and speaking of France, things are getting quite messy. The surprise resignation of Prime Minister Le Cornu, the third Prime Minister to step down in less than a year, has really shaken investor confidence. Markets reacted fast. French stocks tumbled, the euro weakened, and the spread between French and German bond yields, which is basically a measure of risk, widened to near record highs. Le Cornu's resignation couldn't have come at a worse time. He was set to present a new budget to tackle the country's growing debt problem, but that plan's now obviously on hold. France's debt has already topped 3.4 trillion euros, one of the highest in the Eurozone, and ratings agencies have issued multiple downgrades. If nothing changes, interest rate payments could become France's biggest budget expense within a few years. Our French banks were hit hard too, since they hold large amounts of government bonds. Shares in BNP Paribas, Societe Generale and Crédit Agricole all dropped sharply. What happens next is still unclear, which obviously doesn't help in terms of uncertainty. President Macron might appoint a new prime minister and form a new cabinet, or he could even call a snap general election. It could be also possible for him to resign, as he faced mounting pressure to resign following the collapse of his last government. Either way, it's a period of uncertainty for both France and the broader Eurozone. Until there's more clarity, markets are likely to remain volatile, and traders may want to stay cautious around French assets. Well, that's all for this market talk. Stay sharp, manage your risk, and I'll see you soon with more insights on what's driving the markets.